Imagine a high-speed corporate assembly line processing thousands of international transactions until a single misaligned payment jams the gears and breaks the entire system. For practitioners handling cross-border payments into India, that breakdown usually happens when deciding whether a transaction is a royalty or a fee for technical services. Misclassifying these payments results in immediate compliance failures and significant financial penalties. Most corporate finance teams handle these payments through a mechanical routine. They receive the transaction, check the invoice, look up a percentage, and withhold the tax. Under Section 96B of the Indian Income Tax Act, that specific routine is a sophisticated trap. The comfort of a predictable checklist leads professionals to skip the precise legal analysis that Indian tax authorities demand. The root cause of almost every characterization failure is bypassing the rights versus use analysis. To correctly categorize a tax event, you must look past the money moving between accounts and scrutinize the actual asset changing hands. To fix this process, we need to deconstruct the two distinct errors practitioners make, then replace them with a reliable framework. Procedural comfort is a liability. Correct withholding requires starting from legal first principles. The first major point of failure is the instinct to jump straight to the withholding rate. There is a psychological urge to find a percentage number, because identifying a rate feels like solving the problem. Applying a tax rate before conducting a rights versus use analysis makes the final number arbitrary. Tax law dictates a mandatory sequence. The final step, determining the rate, remains inactive until the transaction is characterized. You cannot populate that field without the one-sentence rule. If you cannot describe what the Indian payer is acquiring in one sentence, you operate blindly. Without that specific definition of the transaction, it is legally impossible to determine the character of the payment. If you cannot characterize the payment, the withholding rate you choose is a guess. The rate is the absolute final output of the entire analysis. Prematurely calculating tax percentages accelerates the speed at which you commit a compliance error. The second error is relying on the label printed on the invoice to determine the tax category. Administrative teams processing payments often lack visibility into the legal realities of the underlying agreement. For example, an accounts payable desk might receive an invoice with a line item explicitly billed as a technical support fee. That label implies a service, which pushes the practitioner toward an FTS characterization. Here is the conflict. On the left, the administrative invoice states technical support fee. On the right, the underlying legal contract shows the fee is for a license for diagnostic tool. The invoice claims a service, but the contract confirms a royalty. In Indian cross-border tax, when the invoice and the contract disagree, the contract always wins. Administrative labels are legally irrelevant if they contradict the substantive rights granted in the actual agreement. The transfer of rights defines the legal nature of a transaction, not the piece of paper asking for money. To avoid these traps, we use a framework built on a single question that cuts through the noise of invoices and rates. This decision tree begins here. What is the Indian payer really acquiring? The first path is that the payer is acquiring a right to use or exploit an asset, such as intellectual property, equipment, know-how, or data. Granting access to use any of these assets, including transmission capacity, triggers a specific tax consequence. In these cases, you start your classification with royalty. The second path is the receipt of a service. Here, the non-resident performs work and delivers an outcome, but no right to use an underlying asset is granted to the Indian entity. For this path, you start with fees for technical services, or business income. This binary logic is the definitive method for separating a royalty from FTS. When the Indian payer ends with the use of an asset the non-resident still owns, you have identified the royalty signature. This matrix neutralizes the risk of using premature tax rates or following misleading invoice labels. Following this logical deduction resolves roughly 90% of all cross-border payment classifications. Mastering Section 96B depends on the rigorous application of this single binary test. This matrix is effective, but boundary conditions do exist in international tax. There is a remaining 10% of cases that this matrix cannot separate cleanly. This final 10% involves complex bundled contracts or transactions with actively contested legal characterizations. Practitioners should not force these complex edge cases through the basic binary matrix. These scenarios require immediate escalation for formal legal and tax review. In most cases, the determination hinges on whether the Indian pair acquires the use of a non-resident's asset. Applying the rate follows the work of characterization. The underlying contract dictates the reality over any invoice label.